Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Welcome, everyone. If you've been watching the financial world lately, there's one name that's probably been hard to miss. Circle Internet Group, Inc. That's CRCL on the ticker.
Absolutely. They're the force behind USDC, the digital dollar, and they're making some serious waves.
Serious waves is putting it mildly. The stock's gone from its IPO price of $31 on June 5th, just a couple of weeks ago, to nearly $200 a share. It's been explosive.
It really has. And this isn't just a stock story, is it? It feels like it's tied into the whole future of digital money.
Exactly. Which brings us to the big question for individual investors like you listening today. Is Circle this incredible golden opportunity, or is this massive surge maybe built on something a bit simpler, maybe even fragile, like interest rate spreads on T-bills?
That's the core tension, isn't it? The profitability versus the potential rate risk.
Right. Should you be worried about what happens if, or maybe when, rates come down? Today, we're going to unpack all of it. The leadership, how they make money, their competitive edge, growth, the financials, and what the market's actually saying. Consider this your essential download on Circle.
Sounds good. Because to really get Circle, you need to look past just the stock chart. It starts with leadership and the model they've built.
Let's start right there then. 1, the architects of digital currency, Circle's leadership. Who is actually steering this ship? Especially in crypto, leadership is absolutely paramount. Circle seems to have this interesting blend, doesn't it? Crypto natives, Wall Street types, tech veterans.
It's a very deliberate mix, and you have to start with Jeremy Allaire. Chairman, CEO, co-founder. He's really the North Star for Circle.
He's got quite the background, right? Not his first tech venture.
Not at all. A true serial entrepreneur. Co-founded Allaire Corporation, went public way back in '99. Then CTO at Macromedia. Founded Bright Cove, the video platform. He sees tech trends early.
And his vision for USDC.
He calls it the digital dollar. Wants it to be as easy and, well, ubiquitous as email. Key moves were partnering with Coinbase for the Center Consortium back in 2018 that really established USDC.
And crucially, navigating the regulatory side. That seems like a big differentiator.
Huge. He's proven adept at it. Getting ahead of things like MiCA in Europe, Japan's FSA regulations, it builds trust, which is gold in this industry.
Okay, so Allaire's the visionary. Who else is key?
Elizabeth Carpenter, the COO. She's the operational engine, making it all run smoothly. Over 20 years in tech and finance. Goldman Sachs, leading digital asset risk management there.
Goldman experience, that's serious.
It is. And she was COO at a fintech that got snapped up by Visa. At Circle, she's streamlined operations, launched the Circle Payments Network CPN in 2023.
CPN, I've heard it called Swift on steroids. Is that fair?
Yeah. That's a good way to put it. Instant blockchain settlement, much lower costs. Her focus on efficiency reportedly cut transaction costs by 30% last year, according to their S1 filing. That's huge for adoption. Plus, she brings a vital global perspective.
Makes sense. And there's one more key executive.
Dante Disparte, Chief Strategy Officer and Head of Global Policy. He's Circle's diplomat, essentially.
Diplomat. I like that. His background.
He was involved with Diem, Meta's failed crypto project. That means he knows the policy landscape inside out, has the contacts. He was absolutely instrumental in advocating for the Genius Act.
The recent Senate stablecoin bill?
That's the one. Passed in June. CRCL stock jumped 6% overnight on that news. Disparte, through op-ed's testimony, has really cemented Circle's image as compliance first. Very different from, say, Tether.
It sounds like a really well-rounded top team. What about the board? Any standouts there reinforcing this?
Definitely. You've got M. Michelle Burns, former CFO at Marsh & McLennan, currently on the Goldman Sachs board, brings serious financial discipline.
And on the tech side?
Bradley Horowitz, a Google veteran, well-known angel investor. So you have that balance. Financial rigor meets tech innovation oversight. It's a strong setup.
So this team isn't just managing, they're actively shaping strategy. Allaire's move to acquire Hashnote for the USYC fund, that diversifies revenue, right? Away from just the T-bills.
Precisely. While Carpenter makes the platform scalable and Disparte clears the regulatory pathways globally, it's a concerted effort.
You mentioned Allaire as a co-founder. How involved are the founders still? Allaire obviously is CEO.
Right. Allaire is deeply involved day to day. Sean Neville, the other co-founder, is less hands-on now, but remains on the board. Provides strategic guidance, especially on the tech side, like with CPN.
And Allaire's leadership style. You said he's not like some unpredictable tech genius types we could name.
No. He stands out for clarity and execution. Look at the track record. Built and sold Allaire Core, scaled Brightcove, navigated Circle through crypto winters. He's shaping the wave, not just riding it.
The numbers back that up.
Absolutely. USDC circulation went from $4 billion in 2020 to $61 billion by May 2025. That's a 15x jump in 5 years under his watch. There is even that Bain study suggesting founder-led firms outperform significantly. Food for thought.
Okay, so strong founder leadership. How are they incentivized? Are their interests aligned with shareholders?
That's always a critical question. Looking at their hypothetical 2025 proxy info, Allaire's 2024 pay included a $750 base, but the real kicker was $12 million in RSUs vesting over 4 years.
4 years vesting, so long-term focus.
Exactly. Plus a $2.5 million bonus tied directly to USDC growth and revenue targets. Total package around $15.25 million. Carpenter and Disparte have similar well-compensated structures.
In line with peers like Coinbase?
Roughly, yes. And crucially, they have significant skin in the game. Allaire owns about 5% of the Class A shares per the S1. At the current market cap, that's over $1 billion.
Wow. Okay, so incentives seem aligned. That long vesting discourages short-term moves.
Precisely. It contrasts with someone like Jack Dorsey at Block, who took no salary. But Block stock hasn't exactly matched Circle's recent performance. Of course, you always have to watch for potential dilution from stock awards, but the structure seems designed for long-term value.
Got it. And this leadership drives Circle's mission, which is pretty ambitious, right? Raise global economic prosperity through the frictionless exchange of value.
It's huge, but actionable. Their vision is USDC as the plumbing for a new financial internet, money moving like text messages. Allaire literally said, "We're building the plumbing for a world where money is digital, instant, and borderless."
And does the company culture reflect that? Or is it just a nice slogan?
It seems to genuinely permeate the culture. They talk about their circular code, transparency, compliance, innovation, integrity. It's not just talk. 10% of 2024 product features reportedly came from internal hackathons.
Like parts of CPN.
Exactly. And their rapid MiCA compliance in the EU wasn't just a policy win. It showed the whole organization rowing in the same direction. That's a cultural advantage.
Okay, it sounds impressive, but no leadership team is perfect. What are the risks here?
Well, there's definitely key person risk with Allaire. His vision and network are so central. Succession isn't crystal clear yet.
Fair point. What else?
Regulatory missteps are always a danger, despite Disparte's successes. One wrong move could really damage trust in USDC. And, the sheer volatility of crypto. A prolonged downturn could test their leadership in new ways.
But compared to others in the space, how does Circle's leadership stack up?
Favorably, I'd argue. They shine compared to Tether's opacity. Coinbase is strong, but more focused on trading, less on this fundamental infrastructure. Ripple's navigated legal issues, but Surface proactive regulatory strategy feels more advantageous. Allaire's blend of tech vision and policy smarts is pretty unique. They seem to be playing chess. 2. The digital dollar machine. Circle's business model.
Good segue. Let's talk about that digital dollar machine. How does Circle actually turn USDC into revenue? It seems complex, but maybe it's simpler underneath.
It is surprisingly intuitive at its core. Circle issues USDC, pegged 1-to-1 with the US dollar. It's backed by cash and short-term US Treasury bills. Think of it as a digital dollar living on blockchains.
Okay, backed by safe assets. How do they make money from that?
Primarily, they invest those reserves backing USDC into T-bills and collect the yield. That's the main engine. But they also charge fees for services minting USDC, redeeming it, integrating with different blockchains.
So kind of like a bank that doesn't lend, a payment network without Visa, and a tech platform.
That's a great way to put it. The complexity comes from managing it across multiple blockchains, Ethereum, Solana, others, and navigating all the regulations like MiCA in the EU or the new Genius Act here.
But they're transparent about the reserves. That seems key.
Critically so. Monthly attestations from Grant Thornton. It builds enormous trust. You could think of them as a sort of digital FedEx for money, fast, global, secure, and crucially, regulator-friendly. That last part is tough.
Got it. So USDC is the flagship product, $61 billion in circulation now.
As of May 2025, yes. Second largest stablecoin after Tether. It's used everywhere, payments, settlements, huge in DeFi. They've processed something like $25 trillion in on-chain transactions since inception. They also have EURC, the Euro version, but it's smaller.
And beyond USDC itself, what else is in the toolkit?
Big things happening there. The Circle Payments Network, CPN, launched in 2023 for cross-border settlement. It reportedly did $10 billion in volume in Q1 2025 alone, truly challenging Swift on speed and cost.
Wow, $10 billion in a quarter already.
Well, USYC. That came from the Hashnote acquisition in January. It's a yield-bearing tokenized fund for institutions outside the U.S. Already got 4% of the $10 billion tokenized Treasury market.
Yield-bearing, okay, so another revenue stream. And services.
Developer services are significant. APIs, SDKs for companies to build USDC into their apps. Over 1,000 companies using them, including Visa, Stripe. That generated $200 million in revenue last year.
It really sounds like they found strong product market fit. Banks, fintechs, DeFi. The demand is clearly there.
Undeniably. And their roadmap shows they're not stopping, expanding CPN, adding more blockchains. They're building foundational financial infrastructure.
What makes their model truly unique compared to, say, just another stablecoin issuer?
It's that intersection. Stablecoin infrastructure, yes, but combined with the reserve income model and that relentless focus on compliance and global inclusion, it sets them apart from Tether's less transparent approach.
And CPN is a real differentiator.
Absolutely. Programmable, 2, 4, and 7 settlement. We heard about a European bank settling $1 billion in trades using CPN in Q1. That's not just incremental improvement, it's transformative for finance.
So a strong model now. What about their journey? They started back in 2013, right? Didn't they used to be an exchange?
They did. It shows their adaptability. Started as an exchange, pivoted smartly to stablecoins with USDC in 2018. Key moments were the Center Consortium with Coinbase in 19, hitting MiCA compliance early in 21, that $1.7 billion revenue year in 24, up 70%, and the recent successful IPO. They'd become the Stripe for digital dollars.
Interesting pivot. How are they structured operationally? Where are they based?
HQ is NYC, but they're global. Own their tech hub in Boston, leased offices in London, Singapore, Dubai. Essential footprint. They outsource audits to Grant Thornton, but keep core tech in-house for control.
How vertically integrated are they? Do they control everything?
Moderately, I'd say. They control issuance, redemption, blockchain integrations, but they rely on external blockchains like Ethereum and custodians like BlackRock for reserve management. It's a balance, lowers costs, but creates some dependencies.
Like if a blockchain goes down.
Exactly. Solana's outage last year paused USDC transactions briefly. It's a risk, but their transparency throughout the stack is a strength compared to others.
And how do they get USDC out there? Directly to institutions?
Primarily, yes. Direct to institutions and developers via APIs. No retail focus in the core model. That developer-first approach with free SDKs has been key to adoption. CPN bypassing banks is also huge for efficiency. One fintech client cut payment costs by 50% using it.
Cutting out the middleman. Okay, let's tackle the big one. Revenue predictability and PRETs. You said 80% comes from reserve income.
Roughly, yes, based on 2024 numbers. About $1.36 billion from T-bill yields, $340 million from service fees. So, semi-predictable. The reserve income fluctuates with interest rates, obviously.
That's the sensitivity we keep coming back to.
Exactly. But the service fees from CTN and APIs are more stable, often contractual. It provides a buffer, but yeah, big rate cuts would definitely hurt the bottom line. That's the key risk to watch.
And other threats. Competition. Regulation.
All of the above. Technologically, new, faster blockchains could emerge. Regulatory-wise, stricter rules or US CBDC are possibilities, though the Genius Act helps mitigate that for now. Geopolitically, U.S.-China tensions could impact the Asian market, which is about 30% of their volume. And competition is fierce Tether's dominance, new entrants like Athena. That's a tough environment.
But they seem resilient. They survived the 2023 crypto winter better than Tether, circulation-wise.
They did. USDC circulation dipped only 10% versus Tether's 20%. The compliance focus helps, and diversification via Hashnote and CPN as resilience, but they're not anti-fragile. Significant rate cuts or a major blockchain failure would hurt. Still, their adaptability, like the CPN pivot, shows real strength. Robust, maybe, but not invincible. 3. The unshakable fortress. Circle's competitive advantage.
Okay, so a resilient, adaptable model. Now let's talk about the moat. What gives Circle a sustainable competitive edge? This is where the long-term investment case really gets built, right?
Absolutely. And Circle's moat is multifaceted and quite formidable. First, think about monopolistic traits. Not a true monopoly, but close in the regulated stablecoin space.
Regulated being the key word there.
Precisely. While Tether has more circulation overall, Circle dominates transaction volume 58% share as of May per CryptoQuant. And those licenses, MiCA, FCA, MAS, they create massive barriers to entry. The Genius Act just digs that moat deeper in the U.S.
So regulation is actually part of their advantage. What else?
Economies of scale, massive ones. With $61 billion in USDC, the cost per transaction drops dramatically. Minting over $500 billion since 2021 cost them only about $100 million in infrastructure. Smaller players can't match that efficiency.
Makes sense. Network effects too, I assume.
Huge network effects. The more people and platforms use USDC, the more useful it becomes. Over 1,000 companies integrated. That creates a powerful flywheel. DeFi transaction volume surged 200% last year, partly because platforms prioritize USDC.
They also seem to position themselves deliberately against others, like Tether.
That's their counter-positioning strategy. Compliance first versus Tether's opacity or Ripple's legal issues. They're the safe stablecoin. It appeals to institutions. Remember that U.S. bank choosing USDC over Tether for $500 million in settlements. That's the strategy paying off.
Are there switching costs? Is it hard for developers or institutions to move away from USDC?
Moderate, I'd say.
Yeah.
Developers face technical work reprogramming. Institutions face compliance reconfiguration costs. DeFi switching is easier, theoretically. But CPN's unique features help create stickiness, especially for institutional clients who come to rely on its speed and efficiency.
And branding. Does the Circle or USDC brand itself carry weight?
Immense weight. It's synonymous with trust in crypto, which is incredibly rare. The transparency, the audits, Allaire's advocacy, it builds loyalty. They can even command slightly higher fees for some institutional services like CPN because of that earned reputation.
They also seem to have cornered key resources, licenses, partnerships.
Definitely. The regulatory licenses are huge. The partnership with BlackRock, who also took a 10% IPO stake, is critical for reserve management expertise. And their talent pool, pulling from Goldman, Google, Visa, plus patents on CPN tech and USDC contracts. Very hard to replicate.
What about their internal processes? Are they just faster or more efficient?
Remarkably so. Their automated KYC/AML processes handle 99.9% of transactions in under a second. That kind of refined efficiency, built over years, outpaces competitors significantly. Faster, smoother, more compliant.
And the technology itself, CPN, the multi-chain contracts, is it truly superior?
Best in class feels accurate, especially for speed and compliance combined. CPN settling 50% faster than SWIFT. For big institutions, that speed is a massive advantage.
Their timing seems almost uncanny, too. The IPO timing, USDC launching into DeFi.
Impeccable timing. IPO right after the Genius Act passed, during a bull run. USDC caught the DeFi wave early. CPN launched just as demand for blockchain payments surged. It's given them consistent first-mover advantages.
And they execute quickly on these opportunities.
Blazing fast. CPN launched in 18 months, 10 new blockchain integrations last year. Their rapid response to the Genius Act lobbying, preparing, shows an agility competitors often lack. Tether seems slower on the regulatory front.
So pulling it all together, how sustainable is this moat?
Highly sustainable, I believe. The regulatory barriers, network effects, brand trust, they're deep. But no moat is truly invincible. A disruptive new tech, a competitor with unlimited funds, they could still pose a threat down the line.
What could erode it? What are those potential threats on the horizon?
New entrants, like a potential JP Morgan stablecoin leveraging bank relationships. Major tech shifts. Quantum computing eventually breaking blockchain security is a far-out but real concern. And regulatory shifts, like a widely adopted US CBDC, could theoretically make USDC less relevant. Not immediate, but things to keep an eye on. 4. The horizon line, growth and resilience.
Okay, a strong fortress. Now let's look ahead. What's Circle becoming? Where does the growth come from, and how resilient are they to bumps in the road?
Their growth strategy is clear and layered. First, market penetration, just getting more people and businesses using USDC for more things, payments, DeFi, those Visa and Stripe partnerships boosting volume 50%, show this works.
Okay, deeper penetration. What else?
Market development expanding geographically. The new Dubai office already driving $2 billion in regional transactions is a perfect example. They're pushing into new territories aggressively.
The new products.
Product development is key. Expanding CPN's capabilities, growing USYC. CPN isn't just a side project. They're aiming for 5% of the entire $2 trillion global payments market by 2030, according to BCG. That's monumental.
And diversification.
Absolutely. The Hashnode acquisition for USYC is explicitly about diversifying income streams. They're aiming for $500 million in annual income from that alone by 2027. They're strategically broadening their revenue base.
That's a solid plan. What's the total size of the prize here, the total addressable market, or TAM?
It's genuinely staggering. You've got new markets like Asia and Africa, huge for remittances, new products coming like blockchain treasury services, digital identity APIs planned for 2026, and that $1.1 billion IPO cash gives them firepower for M&A. Rumors of a DeFi platform buy persist.
So the TAM spans stablecoins, payments, tokenized assets.
Exactly. Stablecoins are maybe $200 billion market cap now, global payments $2 trillion, tokenized assets maybe $10 billion, but growing fast. If USDC hits $150 billion circulation by 2030, as Forge projected.
Reserve income could be $4 billion a year.
Potentially. And if CPN gets 5% of payments, that's another $100 billion in value processed. Add in USYC hitting 10% of tokenized funds. Circle's compliance focus positions them to realistically target maybe 20% of that combined $2.2 trillion TAM. It's audacious, but possible.
How versatile are their products? Do they serve a wide range of customers?
Very versatile. USDC for retail, institutions, DeFi, CPN for banks, fintechs, retailers, USYC for hedge funds. This breadth enhances scalability compared to more niche players.
And their supply chain, are they diversified there? You mentioned reliance on T-bills.
Right. They're diversified across 10 blockchains, which reduces outage risk. That's good. But the 90% reliance on US T-bills for reserves is a key concentration risk. It absolutely ties their fate to US monetary policy.
What about customer diversity? Are they reliant on one segment?
Impressively diverse, actually. The S1 shows 60% institutions, 30% DeFi, 10% retail. Geographically, too. 50% US volume, 30% Asia, 20% Europe. This mix provides stability. A DeFi slowdown might be offset by institutional growth, for instance.
That diversity helps with longevity. How long do you see USDC staying relevant?
High probability, maybe 80% for the next decade at least, driven by blockchain adoption, cross-border payment needs.
Yeah.
The main wild card is that US CBDC, maybe a 20% chance before 2030, but it is a potential disruptor.
Have their products proven resilient in downturns?
They weathered the 2023 crash relatively well, as we discussed, but a really prolonged deep bear market could still bite, potentially shrinking USDC circulation by 30%, according to some estimates. Resilient, but not immune.
So key growth drivers are USDC circulation, CPN adoption, regulatory clarity, partnerships.
Exactly. And the main risks are rate cuts hitting income, Tether's continued dominance, regulatory reversals, and those blockchain outages. High stakes, high potential. 5. Cracking the code. Circle's current financials.
All right, let's get down to brass tacks, the numbers. Financials tell the real story, and Circle seems to be high-growth fintech meets crypto. What should investors focus on?
Okay, let's make this clear. Revenue growth. Explosive. They hit $1.7 billion in 2024, up 70% from 2023. Q1 of 2025 was nearly $580 million, putting them on track for maybe $2.3 billion this year, fueled by that 40% USDC growth.
And profitability. Are they making money?
Yes. Net margin in 2024 was over 9%, about $156 million net income. Q1 2025 saw that improve to over 11%, nearly $65 million net income for the quarter. That improvement is partly thanks to higher margin CPN fees starting to kick in.
You mentioned the rule of 40 for software companies. How does Circle look there?
They crush it. 70% revenue growth plus about a 17% EBITDA margin gives you 87%, way above the 40% benchmark. It screams strong product market fit and efficiency, like a rocket-powered Ferrari maybe.
Okay. What about return on investment, ROIC?
Also strong, 15% ROIC in 2024, better than the fintech average of 12%. Shows they're using their capital efficiently to build out USDC and CPN.
And their balance sheet, cash, debt.
Very healthy. $1.1 billion in cash as of Q1. Minimal debt-equity ratio is tiny, like 0.1. Current ratio is 2.5, meaning plenty of liquidity. They're well capitalized.
Free cash flow. Is the business generating cash?
Phenomenally. FCF hit $200 million in 2024, double 2023. Q1 was $80 million, putting them on pace for $320 million this year.
Yeah.
This funds growth without constantly needing more outside money.
And the crypto-specific metrics, USDC circulation and volume are key.
Absolutely critical drivers. $61 billion circulation, $6 trillion in transaction volume just in Q1. These feed directly into reserve income and fees. Think of it like this. USDC is the gold mine. T-bills are the pickaxe generating yield from every dollar mined. CPN fees are the extra gold nuggets they find.
But if interest rates drop,
That pickaxe gets duller, fast. That's the core financial risk you have to grasp.
how do these numbers compare to peers like Coinbase or Block?
Good question. Circle's 70% revenue growth beats Coinbase's 50%, but trails Block's 80%. Net margin is below Coinbase's 12%, but likely better than Tether's estimated 5%. ROIC at 15% pops Coinbase's 10%. And their liquidity is much stronger than smaller players like Paxos. They stack up well overall. And these aren't just snapshots. The trends are powerful. Revenue tripled since 2022. Margins improved from 5% to over 9%. FCF doubled each year, and USDC grew 40% annually, consistently outpacing Tether's 10%. It shows profitable scaling. But that rate sensitivity shadow, it's always there. 6. The price tag. Circle's valuation.
Okay, this is the moment many investors wait for. We've looked at everything else, but what's Circle actually worth? Where financial analysis meets the often irrational market.
Exactly, and valuation is crucial. Let's quickly touch on margin of safety, basically. Buying something for less than it's intrinsically worth. Getting that $100 bill for $70, it's your buffer against being wrong, especially with volatile stocks like CRCL.
Why does it matter so much here?
Because it tells you if today's $200 price tag is a bargain or a potential trap. Overpay, and you risk big losses. Find undervaluation, and the upside is huge. For Circle, it really boils down to USDC growth versus interest rates. Getting that balance right is key.
So how have you approached valuing Circle? What methods did you use?
We look at a few angles. First, intrinsic value using a discounted cash flow, or DCF. We projected cash flows assuming, say, 40% annual USDC growth, CPN hitting $500 million revenue by 2030, use a 10% discount rate.
And where did that land you?
Roughly $150 per share intrinsic value, assuming they hit around $8 billion in revenue by 2030. It's just an estimate, of course, based on those assumptions.
Okay, DCF gives $150. What about comparing it to peers? Relative valuation.
Right, using price to sales. CRCL trades at about 9.8 times sales. That's higher than Coinbase at 7x, but lower than a private giant like Stripe at maybe 12x. So at $200, it's priced for strong growth, but maybe not outrageously so compared to peers.
Any crypto-specific metric?
Yes, market cap to circulation ratio. Circle's $24 billion market cap versus $61 billion USDC gives a ratio of 0.4x. That seems reasonable compared to Tether's estimated 0.6x. The DCF works well for the predictable reserve income part, while PS gives market context. Triangulating helps. Now, let's steel man the arguments. You need to understand both the bear and the bull case.
Let's hear the bear case first. Why might CRCL be overvalued or risky?
Okay, bears, like maybe Charles Moon at Prosper Trading Academy, point to that 9.8x PS versus Coinbase's 7x and scream overvalued. The biggest fear. Lower rates having reserve income, crushing profits. Plus, Tether's dominance in the looming threat of CBDCs.
And what about retail sentiment? What are the bears saying on X?
You see accounts like Luciano BTC calling it a bubble, arguing the 24B cap isn't justified versus Coinbase's broader business, worries about the 50% revenue share with Coinbase via Center, and that constant refrain. CRCL's T-bill gravy train is over if Fed cuts.
Ouch. What's the potential downside if the bears are right?
If rates fall hard, say to 2%, and USDC growth stalls, some projections, even mentioned by Forbes, suggest the stock could drop 80%, back towards $40 a share. That's the nightmare scenario.
Okay, that's sobering. Now, paint the bull case. Why could CRCL go much higher?
Bulls, including institutional takes like in Forbes, see a path to $300 a share by 2030. That relies on USDC hitting $150 billion circulation and CPN grabbing 5% of that massive global payments TAM.
Big assumptions, but what gives them confidence?
Big money players putting their money where their mouth is. BlackRock's 10% IPO stake, ARK Invest buying $150 million worth, that's strong institutional conviction. And the Genius Act is seen as a massive de-risking event, providing regulatory clarity.
And the retail bulls on X, what's their vibe?
Pure excitement. Accounts like at BankXRP at Coinburo, they love the IPO, see Circle as the bridge between TradFi and crypto. They adore Allaire's vision and CPN's swift killing potential.
So the bull outcome.
If USDC keeps growing 40% annually in CPN scales, Circle could triple revenue towards $6.5 billion, justifying maybe a $45 billion market cap. That translates to around $300 per share.
Bear case $40, bull case $300. Which is more probable in your view?
I lean towards the bull case having a higher probability, maybe 60%. The regulatory momentum from the Genius Act, USDC's traction, CPN's growth make round, these seem potent enough to outweigh the immediate rate risks. Circle's compliance moat, which Tether lacks, plus that $1 1B cash cushion, makes them resilient.
So for investors looking now at around $200, is it a discount or a premium?
It's trading above our $150 DCF estimate, so technically a premium to that intrinsic value. But it aligns pretty well with the bull case growth assumptions. It's not deeply discounted, but if USDC hits $100 by 2027 feasible at 40% growth, there could be a 25% margin of safety baked in even at this price. You, the investor, have to weigh that rate risk against the strong competitive position. 7. The market's pulse. Current events and conversations.
Okay, valuation is complex. Let's shift to the here and now. What's the latest buzz? What events should investors be watching? The market moves fast.
Absolutely. Recently, the big news was the Senate passing the Genius Act on June 17th, immediate 6% pop for CRCL.
Yeah.
Before that, the successful IPO on June 5th, raising $1.1 billion at a $6.9 billion valuation. And institutional interest is real SBI Holdings from Japan, just invested $50 million.
So positive momentum recently. What's coming up?
Key things to watch. The House vote on the Stable Act, expected maybe August. Approval would be another major legitimacy boost.
Yeah.
Then Circle's Q2 earnings report in July, our first real look at CPN and USYC traction since the IPO. And keep an ear out for rumored major bank partnerships.
So watch the House vote, Q2 earnings, partnership news, and new blockchain integrations. Got it.
Those are your near-term catalysts and data points.
What about the chatter online? What's the dominant narrative among individual investors on X right now?
It's definitely dynamic, but leans bullish overall. You saw huge engagement on posts from Allaire at Jeremy Allaire and Neville at Snevel about the IPO. Influencers like at Coin Bureau hyping it as the TradFi crypto bridge got tons of retweets. There's real excitement.
But also skepticism. We had the bear arguments.
Oh, yeah. At Luciano BTC and others pushing back on valuation, comparing it to Coinbase, highlighting Tether's lead. Lots of likes on those posts, too, so it's not universal optimism. That fear of rate cuts is very prominent. T-bill gravy train is over, is a common sentiment.
Any neutral voices cutting through the noise?
Some, like at Roundtable Space, focus on fundamentals, praising the cash hoard but questioning the PS ratio, trying to be balanced.
So the overall narrative is?
Circle, crypto leader, strong fundamentals, BUT valuation and rate sensitivity are major debate points. Investors seem focused on long-term USDC growth, regulatory wins, and CPN's potential, trying to look past the short-term noise. 8. The bottom line. Answering today's big question.
Okay, let's bring it all home. We've dissected the leadership, the model, the moat, growth, financials, valuation, the current buzz. Time to answer the big question we started with. Is Circle too reliant on T-bill spreads, and should you, the individual investor, really worry about lower interest rates?
Right, the bottom line, based on the data, Circle's reliance is significant, yes, but it's likely manageable. In 2024, 80% of revenue, $1.36 billion, came from reserve income tied to those 4.5% T-bill yields on $61 billion USDC.
So what happens if rates fall, let's say by 1%?
A 1% cut to 3.5% would reduce that income by about $610 million, roughly 36% of their total revenue, all else equal. That's a substantial hit, no question. However, Circle has buffers. At $1.1 billion in cash plus $340 million in fee revenue last year provides cushioning.
And they're actively diversifying away from that T-bill income.
Aggressively. The Hashno USYC acquisition, CPN's growth, the goal, as Allaire stated, is 50% non-reserve revenue by 2027. So for you, the investor, be cautiously concerned. Take a long period of very low rates, say 2% by 2026, could indeed have profits.
But resilience factors exist.
Definitely. The moat regulatory trust network effects, CPN. USDC's continued 40% growth and institutional adoption like Visa, using it for billions in settlements, help offset rate risk. Compared to Tether's 90% reliance on reserves, Circle's diversification strategy is a major strength. The Genius Act tailwind and that cash pile make them a relatively safer bet in a rate cut scenario. Built to bend, hopefully not break.
That's a really clear, nuanced take. So to give our listeners an edge, let's talk asymmetric info and risks the market might be missing. What are the key truths investors might undervalue?
Okay, key truths, the potential upside edge. First, CPN potential to disrupt Swift's 2T market. A 50% cost reduction for clients is a massive, possibly underestimated growth driver. Second, Allaire's regulatory network, his connections. It's a soft asset, but gives them a real edge in shaping favorable laws. Third, USYC, it's small now, but poised for growth in tokenized funds, could add $500 revenue by 2027 if it hits 10% market share. Market might be sleeping on these.
Okay, potential upsides. What about the key risks, the known unknowns we need to track?
Rate cuts remain #1. A 2% Fed rate could have profits, Tether's dominance isn't going away easily, and blockchain outages, another major Solana-like event, could hurt trust and volume. These are well-understood risks you need to monitor.
And the really uncertain things, the unknown unknowns.
The US CBDC appearing sooner than expected is one unlikely before 2030, but would be hugely disruptive. Major geopolitical shocks, say US-China impacting the Asian market, are way out there. Quantum computing breaking blockchain security by 2035. Hard to predict, impossible to ignore completely.
So putting it all together, what's the investor edge? How should someone approach CRCL?
Consider buying on significant dips, maybe below that $150 intrinsic value estimate as a starting point. Closely watch the House Stable Act vote, Q2 earnings for CPN USYC proof points, and track Tether's regulatory situation. Their problems are Circle's opportunities.
Final verdict.
Circle is a high-risk, high-reward play on the future of digital money. The moat, growth, and leadership are top tier in crypto. But the rate sensitivity and competition require constant vigilance. It's about their ability to keep adapting and executing in this incredibly fast-moving space. It really feels like Circle isn't just about a stock. It's about laying down the fundamental rails for how value might move globally for decades. Grasping that long-term, almost invisible infrastructure build beyond the daily stock swings, that's where the real insight lies for an individual investor. It's foundational. A profound way to think about it. They're not just participating in the market, they're building the market's future plumbing. Thank you for walking us through that complex picture today. And thank you all for joining us. We hope this gives you a much clearer understanding of Circle. Continue your own research, think critically about how companies like this might reshape finance, and invest wisely. Until next time.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.